growth depends upon debt to GDP ratio. Growth will turn into negative in the long run if debt to GDP ratio crosses 90%. Higher public debt and lower GDP growth rate bring lower private final investment expenditure and lower private final consumption expenditure, which puts pressure to increase government borrowings, which increases government debt. And finally, it worsens India's sovereign credit ratings. Excess debt brings inflation, higher interest rate, higher bond yields, with poor asset quality. Inflation is a systematic risk. It cannot be avoided. So it puts pressure on investment, on consumption, on savings. By bringing lower asset quality. In Indian context, the public debt has increased 100.9% in 2019-20, which is too much higher to the 76% of public debt of 2014. So the need of hour is to maintain sustainable debt for economic growth. Debt to GDP ratio can be measured on the scale of interest rate, growth rate differentials. Any imbalance between interest rate, growth rate differential brings or puts pressure on sustainable debt, on sustainable economic growth. When real GDP growth rate plus interest rate is higher to the sustainable growth rate, it means debt is sustainable. While when the real GDP growth rate plus interest rate is lower to the sustainable growth rate, it means debt is not sustainable, it is unsustainable. Here, the interest rate and growth rate differential in Indian context is 4%, which can be increased by increasing gross fixed capital formation. Here it means the sustainable growth rate is on and above 4% of interest rate. So, to maintain sustainable debt, the sustainable growth rate should always remain above to 4% of interest rate. Here, in Indian context, gross fixed capital formation has declined massively and it has remained around 36% in 2019-20, which is too lower of 46% gross fixed capital formation of 2014. Here we see that higher public debt, that is 100.9%, lower credit growth rate, that is around 6%, lower gross fixed capital formation, which is around 36%, which is also too lower, and it has brought the GDP growth rate around 4% in 2019-20 before pandemic. And on the other hand, we see that in 2014, when public debt has remained around 76%. Gross fixed capital has remained above to 46%, while credit growth rate has also remained above to 11%, has brought GDP growth rate around 8%. That is almost double to the 4% of 2019-20. This is the situation. Here, presently we see that in the midst of rising crude oil, rising edible oil, rising global commodity prices, rising input costs, rising logistic costs, the inflation, domestic as well as imported inflation, along with wholesale price index, inflation is on a rising trend. This situation has brought higher government borrowings, which puts pressure for higher debt, which finally worsens the India's sovereign credit ratings. And in this situation, we see that government bond yields of 10 years has increased, and it has touched around or above to 6.3% recently, which will, in this situation, going to touch above to 6.5% bond yield on 10 years government bond. This is the situation, and this situation has brought higher government borrowings, higher public debt, lower GDP growth rate. And this situation is not good in the interest of GDP growth rate. And falling GDP growth rate, rising inflation rate, rising government borrowings are putting pressure on inflation. And all these make the situation the worst one for the vulnerable section and the major portion of the vast portion of the middle class, who are the contributor of above than 61% in GDP through their consumption expenditure. This is the situation, and a lot of thanks to my viewers.